Behavioral inflection reversal. What next? Welcome to a follow-up session with the Foundation for the Study of Cycles with myself, Ron William, Development Director. Our key agenda for today's session is threefold: behavioral inflection point, triple whammy headwinds, and market scenarios. We'll drill down into each of the key points relating to the sections one by one. And as a post-session education resource, please review related media coverage with Real Vision, themed rally on thin ice, predicting the flash crash that just passed into Q3, and then a follow-up with CNBC Europe, asking the question, what next? All featured as part of the Foundation for the Study of Cycles monthly vlog. So let's begin. Behavioral inflection point reversal. What happened in terms of the flash crash that just passed, and what next? Picture speaks 1,000 words, cartoons even more. And you can see no exception here with a thematic and timely picture with a speech bubble, hello base, I'm thinking about ejecting, perhaps too late, or just in time, we'll find out. But what's very useful about this is the socioeconomic behavioral insights that remain powerful for lateral thinking and bias optimization during these challenging times. Now, essentially, the behavioral inflection point is the market sentiment overshooting across risk proxies in the last 6 months, already pricing in the so-called promise of a Fed dovish pivot. Now, what this meant is extreme bullishness on the economy, on the market, as well as central bank policy. Here and now, recent analysis predicted growing probability of a dramatic flash crash risk into Q3 just passed in terms of the move into early August, weighed down by compounding triple whammy headwinds, which we'll go into more detail shortly. The market is now in reassessment mode to the changing regime, likely policy shift, and broadening tail risks. The big question is whether this unwind from extreme complacency is going to happen, and if so, by how much? Now, as part of that, we do have to take a step back and look at this crowd wisdom or contrarian signal relating back to one of the best measures of extreme behavioral sentiment, which is the record expectations for a soft landing event. So the bullishness in the economy itself. And we can see here a triple effect compounding over the last few years. Most recently, 2023, where there was a record recession alert, didn't happen, failed. And so market experts doubled up in the opposite direction and switched into extreme bullish mode. That followed 2022, and we had the inflation rate shock, and it seemed like a big weight for the economy and certainly for cost of living, including the geopolitical event risk of the time. And yet we recovered, no recession. And then prior to that, 2021, post-COVID recovery boom, stronger than expected, and recession was alleviated. So all of this is now at historic extremes in terms of complacency, in terms of optimism, and a potential unwind ahead. Here and now, month on month, there has been negative surprises that continue to weigh from an economic macro perspective. This includes softer than expected US growth, hotter inflation, although a nuance in terms of recent data, and weaker labor numbers. The negative market sentiment is being reflected in multiple economic surprise indices, all below zero. So in the real time, economic news is now starting to surprise to the downside, and bad news is being priced in negative sentiment terms. Now, what does this mean from a cross-asset rotation perspective? What's top and what's not? This ranking model, which is a key feature of my work, looks at trends over time from left to right, long-term, short-term, and from top down, the strongest to the weakest. What it shows is a late cycle rotation into Q3 as part of a timing confluence, amplified by US macro slowdown concerns and portfolio deleveraging post-Japanese yen carry trade shock, which we all now know in the headlines. Gold's outperformance is still top. Look at the gold color on the table. Short-term pressure, given the fear unwind during the flash crash, where people were selling first and thinking later. But relatively still strong. Watch gold, yen, and Swiss franc as an early sign of potential near-term weakness, even though we remain at record highs. The long-term trend is part of a transformation stage fueled by strong momentum, positioning, hedging the currency debasement concern with the debt overhang, while boosted by safe haven flows driven by elevated political uncertainty. This will continue to be a key feature for today's session in terms of wildcard risk factors to keep in mind. In contrast, equity markets are starting their predicted Q3 tactical behavioral inflection, the theme of this session, and a bull trap squeeze, which is basically bullish consensus getting it wrong, forced selling in the market because of margin calls and because of a sharp elevation in volatility, unwinding from irrational extreme altitudes. Meanwhile, interest rates are in the bottom position with US 10-year yield breaking to a new 2-month trend low. So that's yields down, treasuries up. Amidst the yield curve steepening, again, recessionary concerns ahead of multiple Fed rate cuts ahead, which is being priced in to the market. Watch out for the Jackson Hole meeting coming up. Now that's the big picture, behavioral and sentiment macro backdrop. Let's move into the triple whammy headwinds, which I've highlighted before in FSC vlog recordings. Now we're going to refresh and update in terms of some of the changes that have played out correctly as predicted. 1, momentum exhaustion divergence. 2, rotation fragility. And 3, cycle asymmetric risk. Follow this step by step because we'll go into detail onto what all of this means, how it's changed, and ultimately what next. Now, in terms of momentum, remember it's the unwind from record extremes. Yes, the market's been strong forever, but what does that mean from a historical perspective? Well, the market trend was plus 2.5 standard deviations from trend, 15 positive weeks in the first half of this year of 2024, closing at new all-time highs. We saw it time and time again, telling you that the market was maybe too good to be true and too strong too often. And that was marked by a momentum exhaustion signal developed by Tom DeMark, which got triggered in recent times. The risk zone on that was triggered in June 20, so much earlier before the flash crash in Q3 August, with a risk zone at 55.50 and 55.10. Also, there were some signs of multiple divergences on the momentum indicator. So that was the backdrop, showing that the elastic band had overstretched and was likely to snap back to some degree in the time that it did. It created a climactic bull trap now in play after historic momentum extremes, but watch long-term trend make or break level at 5,200 into the ongoing Q3 cycle window. Look at that rising channel over the last 2 years as that key make or break level, which would then unlock a sizable drawdown to the tune of 20 to 30%. Now, of course, what's changed is the near to short-term price action, which has led to an impulsive oversold bounce, more than most, including myself, had expected. And that has changed the wave pattern. So instead of it being an ABC correction extending lower, now it looks like we have this impulsive oversold bounce, which could make a new marginal high. However, that marginal high is likely to be a head fake signal based on weak, unsustainable momentum, weak in the sense that it's not resilient enough to hold, and the rotation that's driving it is still fragile. And ultimately, the shock that has happened, much like that cartoon that we kicked off with, has left a shock event risk that continues to weigh on the market. Now, what's interesting is if and when this price pattern does unfold, is that it is coinciding as part of a price and time confluence. So if you look at the short-term time factors based on a proprietary technique, looking at sentiment based on macro influences, we can see right here and now we're in a danger zone period, which will last for the next few weeks. Last time we saw something similar to this, it actually did coincide with the flash crash and ultimately the peak, I should say, in mid-July, which led to the flash crash. And then prior to that, we can see in April, triggering then too, that coincided with the solar eclipse, which I did a presentation on behalf of the Foundation for the Study of Cycles. So do be aware of this price and time confluence and the short-term tactical timing based on natural cycles already producing key trigger signals and may likely be doing so again now. Now, what this suggests, if it plays out, is a potential head fake signal, much like the historical rhyme of 2007, which led to the global financial crisis and a big drawdown event risk, which lasted for several years. But it wasn't an overnight event. It was a process, 3 stages as part of a corrective pattern: fall, rally, then rest of fall. Now, the mid part of that 3-stage process is what led to a new marginal high, ultimately a head fake, and then the rest of the fall. So do be aware of this potential renewed bull trap, which actually happened in Q3 2007 and may happen to a similar degree here and now. That's one part of the interesting historical analog scenario. The other is that the larger drawdown actually doesn't happen now, but later on into the new year. That's what happened in 2008. So when we transitioned from 2007 to 2008, which became known as the event risk of the global financial crisis. And it aligns with the strategic top, which is expected into 2025, if we translate it into here and now, confirmed by the Foundation for the Study of Cycles long-term weekly timing model. More to follow on that point. Now let's transition into the second part of the triple whammy event risk, market internals. That is made up of 3 subset points. 1, record concentration, both on historic extremes and on a single stock high beta basis. 2, rapid broad rotation. So even when we shift from mega cap growth tech stock concentration risk into value stocks, that is too fast, too fickle, and not sustainable. And that was already proven out by the straight line move that we saw in value stock appreciation that just came slamming down even harder in the recent flash crash. And then last but not least, the composite measure of all of the above known as the Hindenburg omen, which highlighted this big flash crash event, with more likely to follow. Here are the slides previewed before as part of the vlog coverage with the FSC. I'll begin with the key points here on the right. Concentration risk still weighs at historic Y2K extremes even after the recent unwind, coupled with the rapid and fragile broadening of sector rotation into value stocks. That's already been proven out. And then the point on single stock high beta, asymmetric risk amplified by originally 10 mega cap growth stocks, then 5, 3, and then finally 1. Which one? NVIDIA. I think approximately 30% of the S&P 500's year-to-date gains was just one stock, and more than half was just 4. So that's great on the upside when you're long and making money. That's a big roller coaster ride when it goes in the opposite direction. Last but not least, that infamous, ugly-sounding composite measure signal, Hindenburg omen, and it's called that for a reason. Big warning shot if and when it triggers. Last time was 2019, going into the COVID shot, then 2015, 2007, and other big market falls prior to that. It did trigger ahead of this flash crash, and actually, warned about it, but it continues to highlight the market internal fragility that will likely continue to weigh. Last but not least, timing, important in both life and markets. And of course, here at the foundation, as part of asymmetric risk, the compounding effect of a mix of non-diversified timing filters, looking at 3 key measures. The first is the foundation timing model. Second is seasonality going into Q3. And third is the US election pattern, for an update after the recent changes that we have already experienced. Looking at the FSC timing model, short-term timing risk is likely to extend into Q3, September, more specifically. You can see there in the chart on the top left. That would take us into the US election season of October, then November, as part of a long-term strategic top in 2025. Look at the chart on the right, showing you the weekly cycle signal and that top going into early 2025 with a potential bottom into 2026. So short-term risk into September as part of a long-term top into the new year of 2025, which, quick reminder, is in line with the 2007-2008 global financial crisis historical analog that we just shared. Watch the latest FSC Cycle TV video by Lars von Thienen, focusing on the timing confluences of this weekly and daily, as well as new sentiment data. And now that sentiment data, which is actually based on solar activity and how that impacts mood and markets, you can see the projections by scientists also suggesting that peak out likely taking place this year into 2025 faster than expected. And now what that does is, as that external data source peaks out, remember, it's a direct influence on investment sentiment and then markets, that also then peaks out euphoria. So interestingly, we're also getting a confluence from that data set, which has already been introduced by the team in recent resources that we've been sharing. More to follow in education output that I'll be developing in future on that data set. Now, let's look at the other timing filter, seasonality. That's the changing of the seasons throughout the year, how it impacts cross assets, in particular US equities. Remember the sell in May effect, which sometimes impacts. The most important part of that is actually September, October, where we get the biggest drawdown. But the lead up to it is a midsummer rally in mid-July into August, where we then get a peak out late August, typically into early September. We already experienced a variation of that, although we peaked out earlier. And then the biggest drawdown, as mentioned, in September, which then leads to a false low followed by a true low in October. We remember October as the anniversary month of market falls and crashes, because that's where the extreme true low of the market move is. But the biggest drawdown is the month before, typically, when you measure it out statistically. Now, what this all shows is that markets are rhyming to the seasonality pattern. More so when you have a strong first half of the year, the negative drawdown effect in Q3 tends to be stronger too. Last but not least, US election pattern, which is going to be very important in the bellwether market of the US, where politics and policy clearly matters. And a lot of people were saying, well, maybe this time was different. It clearly was. Look at that chart in the on the left side, showing the outlier gains for election cycle performance during the summer. So typically it is positive, approximately 7% between June to August on average, but much stronger in this current example. That's the black line to the top side. And of course, the crash that followed shows further mean reversion catch up to the downside, which is likely going to continue into September, October. And that is the traditional part of the pattern. You can just see the drawdown effect in all election years and post-election years going back many decades. Now, what's interesting, of course, is last time I presented this part of the timing framework, I spoke about expecting the unexpected, but how would we ever know about what did happen? The Trump assassination failed attempt, followed by the Biden dropping out of the election race, two big unforeseen wildcard risks that triggered and led to a surge in US election uncertainty. So while there is a little bit of an unwind from this climax effect, clearly this is going to be top of mind, particularly as we now go into the countdown of the election race that will continue to weigh on markets, not least as it already has, and will likely continue. Remember, it's a unique setup in terms of the front runners, policy variation, and the uncertain macro environment, especially on the geopolitical front. Okay, let's wrap up now on macro risks that we can keep top of mind as markets continue to be in this make or break transitory state. Tail risk scenarios, if we look at the left side of the probability curve of event risk, i.e. negative, things that can keep us up late at night for the second half of this year going into the new year. If you follow from right to left, Japanese yen deleveraging, Fed policy, checkmate situation, recession, and geopolitical shocks. The idea is not to predict, but to prepare, or at least combine the two intentions. Then create some kind of scenario plan for each of these event risks as part of a situational awareness exercise, which is really important, from a behavioral mindset perspective when you're making decisions in investment, but also in terms of actually developing a robust decision-making process with your portfolio. And then, of course, keep in mind that these are the most viable event risks. Ask yourself the question, what might the impact be, and then prepare for that accordingly. Now, just as a quick review, Japanese yen deleveraging ahead is the most formidable risk, and clearly the one that already was the headline trigger to the Q3 flash crash. It was the sharp appreciation of the yen coinciding with a spike in cross-asset volatility, thereby heightening the focus on this yen carry trade. Watch Cycles TV video by Dr. Richard Smith, FSC chairman, for more in-depth coverage. However, there are three key considerations to note, and I can speak about this more in future. for all of the market expertise that is trying to highlight the yen carry trade exposure and how much of it is unwound, I think the estimations are around $4 trillion based on government figures. Keep in mind that no matter how expert or data intensive this analysis is, it is still data limited, and we are within this ongoing market shock that has yet to be fully revealed. The other point is it assumes that markets are stable. Clearly, we know here at the foundation that markets move in a cyclical sine wave from stability to instability, low vol, high vol, bull trend, bear trend. And so if the Japanese yen were to shift trend even more, that could add further risk. And then the last point to highlight, of course, is the asymmetric reflexivity, i.e. Animal spirits in markets, and how that can obviously amplify the situation. Now, if we look at the chart analysis, dollar yen's corrective breakdown is looking extensive, could target 140 with risk into 134. That's dollar depreciation, Japanese yen appreciation. Additionally, yen net shorts hit its 2007 record peak and will likely mean revert to a new long regime as part of that appreciation ahead. The bigger Japanese yen cycle wave, you can see an 8-year cycle just in the bottom right-hand chart. Now, one of the factors that may add further weight to Japanese yen deleveraging is US dollar vulnerability. And you can see there a chart top left showing the dollar outlier effect based on positioning and valuation when compared to other major currencies. In addition to that, there is a major top on the dollar index made in 2022, sideways consolidation thereafter into 2024 this year, but we have just seen a near-time breakdown, which is still starting to unfold on the foundation cycle software risk into 2025. You can just see the down move there on the chart. I'll just highlight it there as a potential risk ahead. And of course, that opens the big question on the Fed policy checkmate situation, a top macro event risk during this time window, especially ahead of the Jackson Hole event coming up. This is in line with a precarious historical rhyme, which is what this chart shows. With real rates now at 2% for a while, it's important to review past episodes to be aware of what happens when the Fed forces such a tight policy for too long. Look what happened in 2007, GFC, and Y2K tech bubble crash. And just to close, two more event risks to keep in mind: a recession alert, the yield curve steepening. Again, we know that to be a recessionary alarm bell. Follow our previous videos on this subject for more details. But essentially, this is also confirmed with mega cap tech leading the downside as it did just recently. Gold copper ratio also elevated, which is an additional signal reflecting growing probability of recession, already pressured by a recent drop in macro surprise indices that we highlighted at the top of this session: GDP slowdown, sticky inflation, fragile labor data. Now, there's an ongoing debate and frustration on the viability of the latest signal of yield curve steepening and uninverting again, which is typically a recessionary signal with a lag time of about 6 months or so. The duration here and now is approximately 770 days. The only other times in the past century of 500 plus have led to big event risks before: 1929, 1973, 74, and 1978 and 1980, all market shock events. So do keep in mind what we're seeing. Also, you can see there the chart down below showing the percent of 10-year yield curves inverted, and how we're getting a concentration of that right now. So this time is still important, and no matter all the debates going on out there, we should still keep this on our radar screen. Last but not least, geopolitical shock. One of my base case risk scenarios for 2024 is to be alert to broadening geopolitical risk and crisis alpha. This change in sentiment has been growing across Wall Street all year. You can see there more than half of an investment survey from Goldman Sachs and other investment banks are treating this as a danger risk to their portfolio. Increasing concern about how to position should the conflict in Europe, Middle East, especially recently, spread with rising China-Taiwan tensions as well. But clearly, Europe, Middle East are top of mind. Also, a record amount of elections happening this year in make or break polarized situations, shifting to a kind of social mood extremes, essentially making a crisis alpha event. Why haven't we not seen much of an impact yet? Because experts suggest that we need to get more of a broad, prolonged, and systemic risk for this to actually impact markets. And that was the case in past events, as you can see here over the last 2 decades, crisis alpha often driving equity volatility and may continue to do so in the near future. Okay, and to close, a behavioral educational insight in this shift of market regime from stability, complacency to instability and high volatility. Be aware that in behavioral terms, it is time to prepare for a switch from FOMO, fear of missing out, to FOLO, fear of losing out. The performance equity curve on the left demonstrates that fear beats greed in volatile markets. The recommendation is a barbell strategy. Trim profits. Good times are good, and it's always great to be in profit, but make sure you lock it in. Hedge downside risk, build smart diversification. Take note of this well-known market wisdom shared by many pioneers. Warren Buffett warns of the importance of risk management in his biblical reference to Noah's Ark principle, predicting rain doesn't count, building arks does, while Stanley Druckenmiller recalls his worst trading mistake during Y2K after a 30-year consecutive positive track record. The outlier was in 2000 due to the FOMO extremes and the animal spirit need to play. So just keep that in mind, that sometimes it's just better to book profits, manage risk, rather than try and juice out more than necessary of the market cycle, particularly when asymmetric risk is strong to the downside. And this chart shows that excluding the 10 worst days versus the best 10 days wins out. You want a blend of the two, but clearly risk management trumps more often than not, particularly in volatile markets. So that's the education behavioral insight. To close, we've covered behavioral inflection point, triple whammy headwinds, market scenarios, education resources to follow in terms of the media, interviews, and the FSC vlog. That's it from myself, Ron William, FSC Development Director. Please feel free to contact on email, social. We look forward to future sessions as markets continue to move. Thank you very much. Welcome feedbacks and questions. Foundation for the Study of Cycles. Thank you.